This is not how economic empires end. There are no treaty signings, no dramatic announcements, no moment when historians can point and say this was when everything changed. Instead, leverage dissolves through automotive quota adjustments, through pipeline route selections, through the quiet redirection of commodity flows that had been assumed permanent. Most people believe Canada is diversifying trade relationships, managing risk, responding prudently to American political volatility. The language in official statements encourages this interpretation. Market optimization, supply chain resilience, strategic partnerships, the vocabulary of routine economic management. History recognizes something else entirely. Canada is not diversifying, Canada is decoupling. The difference matters because diversification implies choice while decoupling implies necessity. One suggests Canada is exploring options. The other reveals Canada has already decided that dependence itself has become the threat. The automotive sector shows how this operates without announcement. American manufacturers relocated production south. They assumed Canadian markets would remain open regardless. They were wrong. Ottawa reduced duty-free quotas for American vehicles. Not dramatically, just enough. European manufacturers received different terms. Asian companies building facilities in Ontario and Quebec received better terms still. The shift appears small in any single year. Over 5 years, it becomes structural. American vehicle market share in Canada dropped from 73% to below 58%. European brands expanded by 41%. Asian manufacturers established production that serves not Canadian markets, but global export destinations. The facilities are not temporary. The investments are not reversible. This is where leverage changes hands without noise. American manufacturers assumed Canadian buyers had nowhere else to go. They were building that nowhere else, while American executives were calculating cost savings from Mexican labor. The factories are operational now. The supply chains have adapted. The assumption that Canadian automotive demand would remain captive has become obsolete. The energy sector follows identical logic, but with larger numbers. The Trans Mountain Pipeline provides the clearest signal. $30 billion invested. Canadian oil now reaches Asian refineries directly. No American intermediaries. No discounted prices. No dependency on American goodwill for market access. Western Canadians select crude historically traded $15 to $20 below global benchmarks. Canadian producers had no alternatives to American refineries. American buyers captured that discount as profit. The pipeline changed the mathematics permanently. The discount narrowed to $4 to $6. The difference represents billions annually. That money now flows to Canadian producers rather than American refineries. This matters because pricing power reveals who depends on whom. For decades, American refineries could suppress Canadian oil prices through monopsony leverage. One buyer, many sellers. The buyer dictates terms. That arrangement died when the first tanker loaded Canadian crude for Shanghai. The dependency inverted. American refineries now compete with Asian buyers for Canadian supply. The leverage transferred without announcement. Critical minerals follow the same pattern, but with implications that extend beyond current economics into future industrial capacity. Canada possesses substantial lithium deposits, significant cobalt reserves, rare earth elements essential for battery production. Previous frameworks allowed these materials to be extracted as raw commodities, shipped south, processed in American facilities, value captured by American companies. Current regulations require minimum domestic processing percentages before export. The change appears technical. The effect is strategic. Canadian facilities now process materials that American manufacturers require. The dependency inverted again. American battery plants assume they could source materials from Canadian mines. They can source them from Canadian processing facilities at prices Canadian companies determine, under terms Canadian policy establishes. The infrastructure investments reveal how permanent these shifts have become. Port of Churchill Arctic expansion, year-round shipping to European markets, critical mineral processing facilities in Quebec and Saskatchewan designed for Asian customers, electric vehicle battery plants in Ontario built through European partnerships. Each investment assumes Canadian growth derives from global markets rather than American dependence. Each investment creates path dependencies that will not reverse. The timing connects to something larger that American strategists appear to have missed entirely. As America and China compete for technological dominance, Canada positioned itself as the democratic alternative to Chinese suppliers without becoming subordinate to American priorities. European companies seeking diversification away from Chinese dependency prefer Canadian partnerships to American alternatives. Canadian suppliers do not carry geopolitical complications. They do not demand technology transfers. They do not impose political conditions. This creates opportunities that bypass American intermediation completely. European manufacturers source batteries from Canadian facilities. Not American, not Chinese, Canadian. Asian refineries purchase Canadian oil through Pacific routes. Not Middle Eastern, not American controlled. Canadian. Developing nations purchase Canadian nuclear technology without American licensing requirements. The transactions avoid political conditions that accompany American involvement. The pattern repeats across sectors until it becomes structure. Agriculture. Canadian grain exports now route through Arctic ports to European and Asian markets. Nuclear technology. Canadian CANDU reactors marketed globally without American approval. Aerospace. Canadian companies partner with European consortiums rather than American defense contractors. Finance. Canadian pension funds invest in Asian infrastructure projects that do not route through American banking systems. Each sector represents a domain where Canadian economic activity no longer depends primarily on American relationships. Each represents leverage that transferred without confrontation. Each represents assumptions that became obsolete while American policy remained unchanged. This is not a crisis. It is a reordering. American manufacturers paying higher prices for Canadian materials experience this as cost pressure. American industries facing supply chain disruption understand this as competitive disadvantage, but structure does not care about experience. Structure cares about dependencies. Dependencies determine who can say no, who must accept terms, who controls access. Canada built alternatives. Alternatives eliminate dependency. Without dependency, American leverage becomes inoperative. The political economy reveals why this resists reversal. Canadian regions reorganized around global market access made investments assuming continued diversification. Workers employed in facilities serving European and Asian customers will not support policies prioritizing American relationships over established alternatives. Companies that invested billions in Pacific trade infrastructure will not abandon those assets to restore patterns that subordinated Canadian interests to American convenience. The assumption that structured everything has collapsed. For 80 years, Canadian economic policy operated within boundaries. American interests determined. Canadian resources flowed south at prices American markets established. Canadian manufacturing served American supply chains on terms American companies dictated. Canadian prosperity derived from American market access that American policy could grant or withhold. That arrangement exists now only in the institutional memory of officials who have not updated their models to match changed realities. The automotive plants tell the story without words. Facilities in Windsor and Oshawa that once assembled components for Detroit now produce complete vehicles for European export markets. The workers are the same. The expertise remains. But the customer changed. The dependency dissolved. American executives who assumed Canadian labor would always serve American assembly discovered their assumption had an expiration date. That date has passed. The energy infrastructure reveals the permanence more clearly still. Pipelines that took decades to plan, years to build, billions to finance do not reverse direction because American policy preferences shift. The steel is in the ground. The pumping stations are operational. The terminals are constructed. Canadian crude flows to Pacific ports regardless of what happens in Washington. The physical reality of infrastructure creates facts that policy cannot undo. The financial flows show the mathematics of what occurred. Canadian pension funds, managing trillions in assets, diversified away from American market concentration. The shift appears gradual in quarterly reports. Over 5 years, it becomes structural reorientation. Investments in Asian infrastructure, European renewable energy, Latin American agriculture. Each allocation represents capital that no longer flows automatically to American markets. Each represents a calculation that Canadian prosperity requires global diversification rather than American concentration. The resources flow west and east. The prices reflect global markets. The manufacturing serves multiple continents. The prosperity derives from diversification that makes American market access optional rather than essential. The leverage that came from controlling Canadian market access has evaporated. American policy has no mechanism to restore what dissolved because the tools assume dependencies that no longer exist. Threatening market restrictions becomes meaningless when Canadian producers serve customers across multiple continents. Offering preferential access holds no value when Canadian exporters receive premium prices in markets that do not demand political subordination as the price of commerce. The infrastructure cannot be unmade. The contracts cannot be unwound. The relationships cannot be dissolved by American preference. They exist independent of American approval. They persist regardless of American policy. They function without requiring American participation. This is where power moved without permission. For generations, American economic dominance in North America operated through the assumption that Canadian prosperity required American market access. The assumption created leverage. Leverage shaped Canadian policy. Policy ensured Canadian economic activity aligned with American interests, even when those interests contradicted Canadian advantages. The assumption died, not dramatically, not through confrontation, through the patient construction of alternatives that made the assumption irrelevant. Canadian automotive production serves global markets. Canadian energy reaches Asian buyers. Canadian minerals are processed domestically. Canadian agriculture exports through Arctic routes. Canadian technology partnerships operate independently of American frameworks. Each alternative represents a domain where American leverage dissolved. Each represents a calculation that changed. Each represents a future where Canadian economic decisions reflect Canadian interests rather than American preferences. History does not reverse because it is misunderstood. The integration that structured North American commerce for generations has been replaced by a configuration where Canadian prosperity derives from global market access rather than American market dependence. The supply chains will not reorganize to restore American advantages. The infrastructure will not be abandoned to recreate dependencies. The markets will not revert to patterns where Canadian sellers had no alternatives to American buyers. By the time American economic institutions recognize what occurred, the recognition will change nothing. The reordering is complete. The alternatives are operational. The dependencies that gave America leverage over Canadian economic policy have dissolved, not through confrontation, not through dramatic separation, through the accumulation of options that transformed subordination into sovereignty. The junior partner in North American economic integration has become something else entirely, not isolated, not hostile, but sovereign over decisions that American policy can no longer determine.